U.S. natural gas futures slid toward the $2.70 mark on Friday, once again threatening to crack through the chart bottom, supported by record-high production that has averaged an eye-popping 108.4 billion cubic feet per day so far in August. Prices keep grinding lower despite what on paper should look like bullish drivers: hotter than usual summer weather, yesterday's lighter storage build, and the EIA's ever-upbeat forecast. Yes, that same EIA which confidently assures us that prices will rise steadily from now until January, as if supply gluts, storage cushions, and bearish momentum are all just minor inconveniences. The market clearly disagrees, with traders continuing to press shorts while ignoring the happy path painted in government outlooks. At this point, the only thing dropping more consistently than futures might be the credibility of those EIA projections. Meanwhile, the weather isn't doing any favors for the bulls. National demand is set to ease over the coming week as weather systems sweep through the Midwest, Ohio Valley, and Northeast. Temperatures are expected to dip into the mid-60s to low 80s, curbing the need for air conditioning and cutting into cooling-driven gas consumption. Looking further ahead, atmospheric models indicate cooler than normal conditions from August 28 through September 5, a stretch that is likely to further dampen demand from power generators and keep upward price pressure in check. And finally, the Baker Hughes natural gas rig count report, released at 1 p.m. today, added fuel to the bearish fire. The number of active gas rigs remained unchanged at 122 compared with last week, showing no signs of slowing the pace of production growth. While this is up from 97 rigs a year ago, the market is clearly focused on the message that drilling activity remains robust, supporting continued supply and leaving little room for bullish sentiment to take hold. Traders interpreted the static rig count as another confirmation that the oversupplied market isn't going anywhere anytime soon, reinforcing pressure on prices that were already struggling. Meanwhile, the price decline really gained momentum after July 18, when we saw the first significant jump in gas rigs, climbing from 108 to 117. It appears that gas producers have no plans to cut back on rigs for now, seemingly betting on higher demand later in the year. They don't seem fazed by prices potentially slipping to the uncomfortable $2.50 level or even lower, which suggests that the market is likely headed for a shallow dip during the shoulder season. Looking ahead, the expectation is that prices will rebound above $3 once the heating season kicks in, bolstered by the launch of new LNG terminals in December or January, coinciding with heightened winter demand. In short, producers are playing the long game, willing to endure a temporary slump while positioning themselves to benefit from the seasonal surge. Despite Thursday's bullish EIA report, the broader market setup remains under pressure from high production levels and waning weather-driven demand. Unless short covering accelerates, natural gas prices are likely to stay capped below $3, with downside risks growing if the $2.75 support level fails to hold. While a solid support zone has formed around $2.75, a breach below $2.72 could open the door for a steeper slide toward $2.50, reflecting the market's continued oversupply and muted near-term demand. Meanwhile, the same critics who laughed at me for being too negative on natural gas are now the ones eating their words. Prices tanked, and those who followed my lead almost doubled their money on bear ETFs since June. Irony has a wicked sense of humor, doesn't it? Moreover, if natural gas prices were to decline further and test the $2.50 level, bearish ETFs tracking the sector could see significant gains. Funds such as coal may climb toward $50, reflecting the intensified downside pressure in both the physical and futures markets. Don't forget to comment, watch the previous video, and show some love for the channel. See you next time.